Okay, our official start time, 12:02. So welcome to our monthly edition of just our webinars that we're going to be coming with different topics. We've been doing that. We're continuing. I'm excited to be talking about investments today, since that's one of my main responsibilities is that. So welcome to what we've titled portfolio diversification, a portfolio built for time, not timing. So we're going to have a question and answer at the end of this. We're only going to be doing this for 15, 20 minutes or so. We'll have a question and answer, and then we'll talk about what's coming up next. So to begin, the context of what we're talking about today, diversification is a piece of what we do in investments. So we want to talk about the entire process a little bit, just to put it in context. So to start with, we want to just, the phrase investing as a process over time, not a point in time, is something that we've really focused on. It's a phrase that a commentator that I listened to has said over time, and it's just that. It's so often the financial press and others want us to look at a specific point in time and say, what should you be doing right now? And that's a point in time. And so the investment currents are pretty strong, and the cross currents as well. So to look at a particular point in time misses the overall picture, which is what we want clients to focus on. And so one chart to really illustrate that is this one here, where it looks at time in the market is more important than timing the market, because it looks at a period of time. It says since 2000, you've got 20 years here. And some of this is a little blurry, I see. But if you go and look at the returns, and then you look to what happens when you miss the top 10 days of the performance, and you see that your investment returns are virtually cut in half. So you've got 7.5% to 8% rate of return over the 20 years in the S&P 500. If you just miss the 10 days, the top 10 days, your investment performance is less than half of that. So again, trying to time things, the adage has been that sometimes the bulls win, sometimes the bears win, but hogs always get slaughtered. It's a long, old saw, as it were, just meaning that on any given day, those who are bullish on the market, horns up, bullish, are winning the day. Sometimes the bears do. Those who are betting for the market to go down, claw down, they're winning. But those that are trying to really get cute, or either get risk off the charts, or trying to time the market to maximize their returns, they're saying those are the ones that can get sloppy and hogs get slaughtered, as it were. So that's really just to, again, focus on, you need to be in the market, because you don't know when these things will occur. When will the top 10 days occur? And so, we don't know anybody who's timed those things. There's some people who time it from time to time. So, because in the short run, the market is a voting machine. On some days, it's supply and demand on a daily basis. So, sometimes people think we're getting cute when we say, well, what happened in the market today? Well, more people bought than sold. But in reality, that's what it is. Just there were more people buying stocks that particular day than sold. So markets are going up. So why did that happen? No one really knows. You won't know. You probably never specifically know. You can know maybe a point in time over a trend and see what was going on there that was looking forward. But over time, though, stocks, individual stocks and markets, they're a weighing machine, as Benjamin Graham said, and others have posited that also, that over time, it's a weighing machine. It looks at companies' growth, looks at the earnings, and values a company accordingly. So we're looking for the long term. Now, it doesn't mean we ignore the short term, because in the short term, there's things that are occurring. So in the short term, this chart is looking to contrast two things that are happening, where on the left, or on the side where it says, e-commerce, where the digitization of commerce, you can see the chart is upwards in movement. And then during COVID, things really ratcheted higher. Well, that's a trend that several of active funds that we use have really keyed into over years. And so they had good years, especially last year, because that accelerated, and those that appreciate that valued companies accordingly also did well. So that gets into the strategic investing that we like to focus on, is what's happening, what are the longer term trends. And so, but on the other side is what's happening with Bitcoin. And you almost can't talk nowadays without referring to Bitcoin. Anyway, so Bitcoin, didn't do all its run up in the last year, but it's done substantial amount of run up now. And so why is it doing that? Well, again, it's supply and demand. There are more people buying than selling. And so as it turns out, there's a small handful or small percentage of buyers that are actually doing that. And they're running the price of Bitcoin up. And so where does it go from here? I mean, who knows? There's a lot of cryptocurrencies. We've talked here, Drew's talked about it. And so we continue to look at it. But right now you've got some folks that are really buying it up at a very quick pace, obviously. And so a lot of money's already been made in Bitcoin. And how long will Bitcoin be the cryptocurrency on into the future? A lot of people are still studying that. Another thing that's being talked about currently is inflation. And so there's a lot of people convinced that inflation is something that to deal with, into the future. And we were in that camp, 10 years ago. We were sure that inflation was going to hit. And this grand experiment of the Federal Reserve and the longer term demographic and economic cross currents occurring have kept inflation in check. In fact, the 35-year move of interest rates has been lower. And so, yes, there's inflation now compared to last year. You got the disruption in the supply and demand because of the pandemic and the shutdown. So you certainly have some inflation. You've got copper, its highs of 10 years, 12 years. And so there is something, but what is the longer term trend? Because a lot of people are convinced now that inflation is going to happen. And so I hear people say, well, are interest rates going up? It's like, well, no, they already have gone up. They went up substantially from December 31st till today. They've gone up substantially. So, over the longer term, here's what inflation has done. And you see there are periods over this long view that the 70s were really a time where late 60s and 70s where inflation really was uncontrolled. And so there's a lot of dynamics that were going on there at the time. There are some who are still convinced that the long-term trend has still not been broken. Those that have said now that, well, yeah, rates are going higher. Well, back in December, they didn't tell us that rates were going higher from that point, that they were going to go up substantially. You get the 10-year rate going from 93 basis points to 173. So it's almost a doubling. Well, I didn't hear many people predict that. So you've got to take that with a grain of salt. And so we are looking on the horizon. Okay, will inflation be something that is something to deal with, an issue to deal with? Well, there are securities that do better in that type of environment. We know stocks do. Here's a graphic that say, equities are a hedge against inflation. So that's part of what can do that. But there are other things too. And so again, we're talking about diversification today. And so what do you do in the midst of, there's a lot of things that can occur, in the environment, two portfolios. And that's why we think it pays to be diversified. So we start though, the outshoot of goal-based investing, we come to diversification, but we start with that. Before we invest any money for folks, we want to look at their financial situation. We want to see where their strengths and weaknesses are, and what are the things that are going to prevent them from reaching their long-term goals. And so from that is what type of investing do they need to take, they need to commit to, and what can they commit to based on their ability to absorb volatility, because that continues. And then from there, we then go to a diversified portfolio to help them achieve their goals. So in that process, we know that risk, people define risk in different ways, but risk is in the end a loss of capital. I mean, that's what we think of. Volatility has often been described as risk, and that's a piece of it, because volatility can knock people off their long-term goals and just think short-term and think, I've got to make a change. So you've got to know, you got to be able to identify risks, because invariably, when markets are going higher, people don't pay attention to the risks that are inherent, sometimes are growing without heralding, the fact that they're growing fast. And so you've got to identify it. You've got to try to adjust for it, because you need to just account for it, because more things will happen than you think will happen, because you're paying attention to the longer term trends, especially if things are positive. So, in that, we know that the United States, although the world's leading economy, the world's leader in many, many areas, that the GDP of America compared to the rest of the world, we're just a portion of it. So you see, we're, in the high 20s, mid to high 20s of the percentage of GDP across the world. We are somewhere in the neighborhood of 45 to 50% of the stock market capitalization, the value of the United States stock markets as compared to the world's. We're a higher percentage in that. So that doesn't mean we're going to invest 25 or only 50% in US and do the rest overseas, but it does mean that we're going to be overseas, and we have been for some time. And so that's going to continue. So diversification really starts, we can show this graph here looks at asset classes. We call it the quilt, because it's showing you in any one year, going from 2008, I guess, up till last year, is what asset classes did the best. And you can see that in white is a diversified portfolio. The second column from the end shows you what's happened on an annualized basis. And large cap stocks have done well. We're going to address that in a second. And so it'd be great to pick the asset class that outperforms every year. I mean, that would be every investor's goal to do that, but that's incredibly difficult to do. And so diversification, as you can see, there's an above average, it's the fifth from the top over time diversification. And you can see it never gets too far. It's never the top performer, it's never the bottom performer. There's a middle belt, as it were, that you can see diversified portfolio and how that performs. So that's international, that's size of companies, that's asset classes, that's fixed income, types of fixed income. There's all these components that work its way in there. And so diversified portfolio, because I mentioned risk before. Risk is, we think of that as loss of capital, so you can't recover from that. So, but what gets people to make changes? And oftentimes it's the volatility. People, I can't take that volatility. I can't rest at night. And we agree wholeheartedly that, the mission of the company is to help lessen the worry and burden of money management. So you can just pursue things in your life without worrying about, literally losing sleep about what your investments are doing, and whether your financial well-being is taken care of, so you can pursue wealth, meaning relationships and the things that matter most to you. And so if you're being volatile in your securities and you're changing in midstream, well, that's when really risk happens. That's when permanent loss can happen. And so we want to shield from that. So this chart really just looks at, you look at the red piece, and this is United States, this is valuations. And valuations are, well, what has the market done to prices of companies? And if you look as the bars get lower and lower, you see that across the world, there are places that the value of companies are, right now, they're being lowered. And so, but things don't happen over time. Over time, there's where companies have been low valuations, everyone sells out, and then in time people realize, well, wait a minute, there's some value here. We're going to start to revalue these companies. And so that's what happens, and why it performs, why it pays to be diversified. Because if you look at the green here, this is where United States stocks have outperformed international. But then you look at these pockets of several years where the United States underperforms. From 2009, 2010 until the present day, it's been US large cap all the time. But you look at the decade before that, it was not. US stocks did not outperform. And you can see that, the times in the early 2000s, US stocks, in the brown, underperformed. So you can't pick we don't think we can pick, what years the international is going to outperform the US. So it pays to have exposure to all of it, because we know that, in the future, you're going to have the investment community believes that the next 30 years are not necessarily going to be as high rate of return as the last 30 years. And so volatility will continue. We'll address that again in a second. And then even the changing correlations between, bonds and stocks, that is breaking a little bit, because bonds are, they're acting differently. But still, in the panic of last year, the pandemic, you still had, everybody was selling almost even every type of bond, even municipal bonds, to buy treasuries, to buy the safest United States bonds going. Global diversification. This next chart really just says, the people that go into prediction and look at statistical analysis, the old bell curve, and at the end of the bell curve, it says these tail risks, that events that should only happen once or twice in 100 years, but we've had 10 of those things happen in the last 100 years. So how do you provide for that? How do you account for that? How do you adjust your portfolio for that? So diversification will get you there, because you've had the Great Depression, the COVID lockdowns, the Great Financial Crises, 9/11. There's more. We don't think statistical analysis certainly has fallen short of that, and we would too if we tried to make that happen. So again, we're looking to do strategic investing, to not get caught up in the day-to-day. We watch markets on a daily basis, and we're looking for trends that are occurring, but we are not going to be trading on those. We're looking to adjust for long-term strategic things that we think are happening. So again, that's a quick run through for diversification, because we know, and I'm going to give you some time here, some questions and answers will allow you to pipe some in. And we already had one that was written in advance, and I'll address that in a second. So diversification just tells you that, we will look if we think that the US now is going through a significant period where it's going to maybe underperform. We may tweak the numbers that we have from US exposure to international. But again, we want to look at what is the 2 to 3 to 5 year type trend versus what's going to happen in the next 12 months. We had a great question come in earlier last week and said, okay, interest rates are going higher. What's the logic for holding bonds in a rising interest rate environment? And so, well, the interest rate environment rose pretty quickly. And so we didn't know that was going to happen. As I said earlier, very few people did. I remember 4 years or so ago when interest rates, the Federal Reserve was raising short-term interest rates and things were progressing higher. And client was asking me, well, why are we buying these municipal bonds when interest rates are going higher? Why are we buying bonds? It's like, well, interest rates don't go in a straight line. So, okay, they rose for a while and then they came down. Last year, interest rates came down substantially. And so will they go up in a straight line? We don't think so. So bonds are yielding right now, depending on what bond we're holding in the portfolio, yielding anywhere from almost nothing on a short term to you're yielding 5-6% on some international bonds, or on some high yielding bonds, you're 4.5 to 5%. So if portfolios, some of the funds we're using are yielding 3%, and you're down 2.5% on the U.S. aggregate bond index, will you get positive return for the year? And inside of there, they can do things such as hedging. You could also go floating rate, where you're adjusting on the shorter end. So we're being defensive with our bonds. We're being on the shorter duration, meaning we're looking to own bonds that are going to be coming due sooner. And so when they mature, they can be invested at the rising interest rates. Again, you can get adjustable rate bonds also, go shorter term. There's things that can be done along the way. Again, there's diversification. The correlation against most of the risk that's happening is on the stock side. So there's multiple reasons for owning bonds, income, and as an offset to the risk you're taking on the equity side. So we're going to go to see if there are any other questions. And Shannon, do we have any?
Chris, I am not seeing any come through right now. But if if anyone thinks of a question later that they'd like to ask, you can always email us at info@financialconsulate.com. That's info@financialconsulate.com.
That's great. That's great. Certainly. And so our next edition of the monthly webinars is on May 28th. And how can I minimize taxes in retirement? Our own Graham Ewing will be going through that. So we look forward to seeing you then. Thanks for joining us. Have a great day.